Having been privy to these sort of discussions behind, these sort of discussions behind the scenes in the past, given the communications we've had from policymakers so far, Andrew Bailey, Silvana Tenreiro, Andy Haldane, do you think that negative rates are likely in the UK?
I'm not so sure. I think Andy Haldane is well known for sort of shooting the breeze with some of his comments and speculating in public on sort of novel ideas. But the bank's policy when I was on the MPC during the financial crisis was to effectively set a floor of 0.25%. Now, they've moved that down to 0.1%. But you have to ask the question, if negative interest rates are the solution, what is the problem? The problem that we have with coronavirus is not just a weakness in demand, but it's also a big supply shock to the economy. And monetary policy can't really do very much about that. It's probably something that fiscal policy can help more with.
Andrew, you talk about the two sides of the equation there. It's interesting. Over the past 2 hours, we've been talking about the demand, pump up the demand, get the demand back, get the demand back. I want to understand your thinking about negative interest rates, because I look at what happened in Germany. When we went to negative rates, we put it in the GTV library. When we went to negative rates in Europe, the savings rate, for a variety of reasons, ramped higher. Is the risk that if we eventually go to NIRP in the United Kingdom, we fundamentally damage the psyche of the consumer and of the demand side, and that we run for the hills of saving?
Yes, I think you make a very good point. We don't really know much about variations in interest rates at these low levels, and certainly not at negative levels, because we've not even tried it in the UK. But it's quite possible that consumers take the signal that if the bank has gone to negative interest rates, things must be really bad, and then start reining in their spending, not increasing it. But I think the main challenge, actually, that we face here in the UK is to get the economy back going again from the supply side. There are many activities that are locked out at the moment. Now, that depends on the health situation improving sufficiently such that we can open up more of the economy. But that's not something that monetary policy can address. And I think if we do get into some sort of recovery, I think there's more scope for fiscal policy to provide some degree of stimulus to consumers with perhaps a cut in VAT or some other selective incentives to get consumers out and spending again.
Yes, you recently wrote a piece about that in terms of support for consumer spending being needed to lift the UK economy out of recession, Andrew, as well as the VAT cut that you mentioned. What else is sort of needed, and will it actually be enough to boost demand when lockdowns eventually ease?
Well, I think there's three things that the government can do in terms of trying to support consumer spending. The first is something that Rishi Sunak has already done, which is to extend the support for people who are not able to work, the furloughing scheme, and to provide income support for people whose income from work has been badly affected. The second thing could be some sort of generalised incentive, short-term, perhaps 6 months or so, cut in VAT. And the third could be selective incentives to spend perhaps in areas which will help with long-term benefits to the economy, for example, with the climate change agenda in mind. So there are some quite big levers that the government could pull, but we need to release the lockdown sectors of the economy first before it makes sense to really activate those levers.
We don't know how that reopening is going to go, do we? When we read stories like JP Morgan, Goldman Sachs returning to 50 and 20% capacity, Andrew, I think that's reflective of what the challenge is ahead. You talk about capital expenditure. For every £1 that a business contributes to capital investment, consumers spend nearly £7. You talk about a return, you talk about the possibility of driving this economy forward. Is this where fiscal policy needs to lean in next year in regards to capex, in regards to industry, re-engineering the UK economy?
Well, we don't yet know exactly what the long-term effects are of the coronavirus. Obviously, some sectors will not be able to operate at the capacity that they did before, including the public transport system, including restaurants, bars, even when they open up, pubs, etc. They won't necessarily be operating on the same basis because of social distancing. And so I think we need to wait and see how that situation unfolds. But I don't think monetary policy is the lever that we need to pull to incentivize consumers. One is because interest rates are already at rock bottom levels. And secondly, if we go into negative interest rates, that could do more damage for the economy, to the supply side of the economy, than it could do good. And I don't think there's a lot of evidence around the world where negative interest rates have been applied in Europe and Japan, that they really have been that effective in supporting growth.
Andrew, do you agree with the BOE's scenario for a V-shaped recovery? And if you do, what will recover quicker, supply or demand?
Well, I think the V-shaped recovery is the most optimistic scenario. The bank actually described it as a scenario. Similarly, the Office for Budget Responsibility described it as a scenario or a reference case. So these official bodies are slightly hedging their bets and saying, well, they're probably hinting that this is the best possible outcome. And I think the more realistic outcome is a much slower recovery, partly because it's going to take time to unlock certain sectors of the economy, but also because it's going to take time to build back consumer confidence and to build back consumer spending. So I think when people talk about a V-shaped recovery, the sort of second leg of the V may be a lot shallower than the first leg when we were going down.